Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss avoid equity bear markets with a market timing strategy, part 3.
Hello everyone, my name is Radovan Vojtko and CEO of Quantpedia. So today we will finish and wrap up our series of videos about market timing and how to avoid US recessions in US stocks. Once again, there are really a lot of market timing strategies around there and also in our database. In the first video we discussed how to time equity market using price-based indicators. In the second we discussed how to use macroeconomic indicators together with the price-based. And in the first installment, we will discuss how to use yield curve predictors. What is the yield curve and what are the yield curve predictors? The yield curve in finance is a curve that exists on x-axis. You plot different maturities of different US government bonds, treasury bonds, and on a y-axis you plot what is the yield on them. The normal yield curve, positive yield curve, look like this. So it means shorter maturities have a lower interest rate, and as we go on a longer and longer maturities, we have higher and higher interest rate. The reason for that is because when we invest into longer treasuries, we want to have higher returns because we are in a higher risk. The 10-year treasuries should have higher yield than, 1 or 2 or 3 months treasuries or 1-year treasuries. Now that's the normal situation. But there is a situation when there is an inverted yield curve, and that's the situation when the US Federal Exchange is moving with yields higher. It was in 2006, it is currently 2023, and in 2022, US Federal Exchange or the US Central Bank started to move interest rate higher. So in 2006, for example, we had a short rate on 1, 3, and 6 month treasuries around 5%, but 10-year treasuries or 5-year treasuries had only 4.5%. So it means that there was inverted yield curve, so the yield on shorter dated treasuries was significantly or was higher than yield on longer dated treasuries. This inversion in a yield curve can be used as a very nice predictor for future recessions. Here, for example, we have a chart from FRED, Federal Repository of Data, where we have a Federal Reserve Bank of St. Louis, where we have data, and it's using 10-year Treasury constant maturity minus 2-year Treasury constant maturity, and the shaded areas are the recessions. So we see that each time there was inversion in the yield, it was very, very closely followed by a recession. And once again, each time there was an inversion in the yield, it was very closely followed by a recession. And once again, in 2006, there was an inversion in yield, and there was a recession in 2008 and 2009, and also the bear market. And every recession is usually combined with the bear market in equities. So what does it mean is we can try to use this yield curve prediction, and we can try to build a market timing strategy on top of that. There are a lot of papers related to this idea. Estrela and Mishkin from 1996, Resting and Schulsmith 2012, etc. I mean, a lot of the papers. We get the data from Federal Reserve Bank of Louis that are fairly available. We calculated what is the spread between 10-year treasury yield and 3-month treasury yield from April 1927 until June 2022. The shaded areas indicate the bear market in this period. What we can see is that once again we can use the yield curve as a predictor for upcoming recession. Treasury spreads were negative before every major bear market during our sample period. So before Wall Street crash 1929, before 1973, 1974 stock market crash, 1980s recession, dot-com bubble, 2007-2008 financial crisis, 2020 stock market crash, etc. So it can be really used very well. So how the final strategy would look like? So if we combine all of the information from price-based, macroeconomic-based, and yield curve predictors. So the trading rule for our final strategy is as follows. So our strategy, trend, yield curve, and macro stays long in market if the trend and yield curve trading signals are both positive. It means we have a positive price-based signal, we are in a positive trend, and also the yield curve is not inverted. Or the industrial production, retail sales, and dividend signals are jointly positive. So it means the signals about the economic situation shows that everything is fine. So otherwise, the strategy switches out of the market and we are not holding equity. How does the resultant performance look like? So here we have a trend, yield curve, and macro combined together. So we have annual return around 7%, annual volatility less than 12%. What's the most important? We have maximum drawdown only 25%. In case we do not have used any market timing strategy, we just hold the market. So we do the buy and hold. we have the maximum drawdown 84%. In case we use only price-based predictors, 200-day moving average, 10-month moving average, trend following indicator, we still have maximum drawdown 55%. Yeah, it's better than 85, but still have 55%. So when we combine the signal from price-based indicators, macroeconomics indicators, and yield curve, we can cut our maximum drawdown to, I don't know, only 25%, so which is significantly better. So here is the resulting performance chart of the resulting strategy. And here we have a drawdown chart. So you can see, yeah, there are still some drawdowns, but we are able to cut the drawdowns, especially during the recessions and during the bear market. It can be 2000, 80s, 70s, 29, etc. I mean, all of the major bear markets, we are not having the equities during that. Thank you very much for your attention. I hope that you liked this video and also like the previous videos. Once again, all of the links are in the description, and I hope that you join me in some next video. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.